Wall Street funneled $540 million into Solana ETFs in Q4, and investment advisors were the biggest buyers. The first wave of 13F filings from Q4 2025 is in, and the numbers tell a story that quarterly price charts miss entirely. The top 30 institutional holders of U.S.-listed Solana ETFs collectively purchased $540 million worth of exposure during the quarter, according to SEC filings analyzed by Bloomberg ETF analyst James Seifert. Investment advisors, not hedge funds or prop trading desks, accounted for over half of that capital at $270 million as of March 10, 2026. That breakdown matters. When advisory firms allocate client portfolios into an asset, the money tends to be stickier than hedge fund positioning. These are not short-term trades. They are allocation decisions that get reviewed quarterly, not daily. Goldman Sachs and Electric Capital lead the pack. The largest single buyer was Electric Capital Partners at $137.8 million, followed by Goldman Sachs at $107.4 million. Rounding out the top five were Eloquent Capital, SIG Holding, and Multicoin Capital. Goldman's position is worth noting for what it represents. The bank has historically been cautious on altcoin exposure, sticking primarily to Bitcoin and Ethereum products. A $107.4 million SOL ETF allocation signals that internal risk committees at one of the world's largest banks signed off on Solana as a portfolio-grade asset. Morgan Stanley and Citadel Advisors also appeared in the filings. Though their positions were smaller, the presence of these names across multiple 13F filings suggests that Solana ETF exposure is becoming standard in institutional crypto allocations, rather than an outlier bet by a few adventurous funds. The buyer breakdown tells a different story than Bitcoin ETFs. Here's where the Solana data diverges from what happened with Bitcoin and Ethereum ETFs in their early quarters. Investment advisors dominated at $270 million. Hedge fund managers followed with $186.4 million. Holding companies added $59.5 million. Brokerage firms contributed $20.3 million. Banks brought up the rear at $4.5 million. When Bitcoin ETFs launched in January 2024, hedge funds were the dominant early adopters, using the products for basis trades and directional bets. The advisory segment took quarters to build up meaningful positions. With Solana ETFs, advisors move faster. One interpretation: crypto allocation frameworks that took 18 months to develop for Bitcoin were ready to deploy on day one when Solana ETFs became available. The total tells a striking story. Half of all Solana ETF assets are now held by institutions required to file 13F disclosures. That is an unusual concentration for a product less than 6 months old. Bitwise's BSOL fund, the first SEC-approved spot Solana ETF, launched on October 28, 2025. Total cumulative inflows across all Solana ETF products have reached $952 million, 4.3 million SOL tokens. Back the institutional positions. The $540 million in ETF holdings corresponded to approximately 4.3 million SOL tokens at Q4 end prices. At Solana's Q4 closing price of $124.95, these institutional positions were comfortably in profit relative to most entry points during the quarter. Since then, SOL has dropped roughly 30% to 86.53 at the time of writing. That decline means the same 4.3 million SOL tokens are now worth approximately $372 million, a paper loss of $168 million from Q4 levels. The Q1 2026 13F filings, due in mid-May, will reveal whether institutions added to positions during the drawdown, held steady, or trimmed. The price decline also creates an interesting dynamic for the advisory segment specifically. Unlike hedge funds that can cut positions quickly, advisory allocations typically follow model portfolios that rebalance on set schedules. If Solana remains in those models, the drawdown triggers automatic buying at lower prices. If it gets removed, the selling pressure shows up as a delayed wave, not an immediate dump. What this means for SOL holders and crypto card users. For SOL holders, the institutional base provides a structural floor that did not exist a year ago. When 4.3 million tokens sit inside ETF wrappers held by Goldman Sachs and Morgan Stanley, liquidation dynamics change. These holders do not sell on a 10% dip. They rebalance quarterly. The Solana ecosystem has also become a hub for crypto card infrastructure. Cast, which just raised $80 million at a $600 million valuation, runs its stablecoin card platform on Solana. Solflare's card lets users spend directly from their Solana wallet. Gemini's Solana Edition card auto-stakes SOL rewards at up to 6.12% APR. As institutional capital validates Solana as an asset class, the spending infrastructure built on top of it becomes harder to dismiss as experimental. The broader ETF race, Solana versus Ethereum's institutional story. Solana's $952 million in cumulative ETF inflows over roughly 5 months compares favorably to Ethereum's early trajectory. Ethereum ETFs launched in July 2024 and faced months of outflow pressure from Grayscale's Ethic conversion. Solana had no legacy product creating selling pressure, which gave inflows a cleaner path. The comparison is not perfect. Ethereum's total ETF AUM is orders of magnitude larger. But the speed at which institutions adopted Solana exposure and the dominance of advisory capital over hedge fund capital suggests that the Bitcoin first, then maybe Ethereum, then maybe altcoins adoption ladder is compressing. Institutions are now evaluating the full spectrum simultaneously, rather than waiting for each asset to prove itself over multiple cycles. Fidelity has filed for its own Solana fund, FSOL, which would add another major distribution channel. If Fidelity's retail brokerage clients gain access to SOL ETFs through their existing accounts, the advisory allocation numbers could accelerate further.